Hello, everyone. This is Matt with the Fundamental Investing Institute. Thank you for tuning in today. We're continuing our talks on the history of the Federal Reserve, and today we're going to discuss the role that the Federal Reserve played in financing the United States' involvement in the First World War. Recall from our last video that the Federal Reserve Act was passed in December of 1913, and the system became operational late in 1914. And of course, this is the same year when war breaks out in Europe. War broke out in the summer of 1914. Now, the United States did not enter the war initially, but we did provide material to the European belligerents for a number of years. Before we get into that, let's talk about the structure of the Federal Reserve in its early years. There were two operating entities within the Fed. The first was a board that was in Washington. It consisted of 7 members. 5 of those members were appointed by the president and then confirmed by the Senate. And the board was also made up of the Treasury Secretary and the Comptroller of the Currency. So there were 7 members on the board. The other operating entity, probably the main operating entity, at the time were the Federal Reserve banks. These were 12 banks spread throughout the United States. Each bank was responsible to the board in Washington for certain matters, but for the most part they were autonomous. So unlike today, each bank more or less created its own policies. The banks were made up of a board of directors, and they were led by a governor. And these terms get a little bit misleading because, as we'll see later, these titles get changed when the Federal Reserve is restructured in the 1930s. The bank governors are enormously important, and as we'll see later, one governor in particular, a man by the name of Benjamin Strong, who was governor of the Bank of New York, Federal Reserve Bank of New York, becomes kind of the key figure, specifically throughout the 1920s. Now, monetary policy specifically in these early years, we have to keep 3 things in mind. The first is the United States was on a gold standard. Gold standard became law in 1900, and the Gold Standard Act of 1900 specified gold as being worth $20.67 per troy ounce. So what this did is it anchors the amount of Federal Reserve notes that could be created by anchoring that to the quantity of gold that are held in Federal Reserve vaults throughout these 12 banks. And another thing is something called the real bills doctrine. That title kind of came later, but this was basically the belief that the Federal Reserve should only discount or lend against securities, commercial securities that arose from trade rather than speculative securities. And this becomes a major problem. In some ways, both the real bills doctrine and the gold standard become major problems during the Great Depression, as we'll see later. But this is one of the pillars of the early Federal Reserve. The main policy tool that the Federal Reserve used was called the discount rate. And what they would do is they would lend to banks against certain collateral, again, trade bills, and they would lend at a discount to the value of the bills, and that difference was the interest that the member banks paid for the loan. That was their key rate. That was their key means of setting policy. Now, when war broke out, it led to a huge surge in U.S. exports, and those exports were paid by sending gold into the United States. So there was this massive influx of gold into the United States. And because gold is backing the money supply, it leads to a huge surge of the money supply, and it leads to inflation. Now, the other thing is the United States Federal Reserve was trying to keep rates very low to help finance the war. One of the key instruments of war finance was something called Liberty bonds. And Liberty bonds were they were marketed to the general public. They were sold through Federal Reserve banks. And what the Federal Reserve would do is they would lend the member banks very cheap money. They would keep interest rates very low, and then they would sell these bonds to the general public on installment. And the other thing is the Fed would lend very cheaply to these member banks so they could directly buy U.S. government debt. And one of the interesting things about the Liberty bonds is it's backed by the largest advertising effort in the U.S. up to that time. And as we'll see as we talk about the economy in the 1920s, the infrastructure that was laid to promote these bonds becomes very important because it gets the public acclimated to public security markets. In other words, it gives the public a taste for buying stocks and bonds, and that becomes very prevalent in the 1920s. The Treasury at the time was led by a man named William McAdoo, and he was financing the war. They did raise taxes to some extent, but about 2/3 of the war was really financed with borrowed money by selling these bonds to the public and to institutions. And of course, inflation helps as well because it reduces the value of that outstanding debt. But this inflation creates problems down the road, and as we'll talk about in the next video, it leads the Federal Reserve to contract the money supply in a big way. It leads to a very deep recession in 1920 and 1921. We'll talk about that next time. Thank you for tuning in.